Good morning, everybody. Mike Vacchi, Princetontrader.com, here with your Thursday market webcast. Okay, we talked about the 9-day. We talked about the daily mid-band. We've tested that area in Globex overnight. The bears did a very nice job of doing an initial rejection up there in and around 38.18, 38.19, 38.20. They've pushed it back now. We traded as low as the 63, 64 area, right back around where they opened up the regular session yesterday at 37.59. So, couple few day rally, a little bit of a pushback. Jobs is tomorrow. We'll see what kind of energy this thing has today. The thing that continues to it doesn't bug me, it just concerns me, is that we're due for a consolidation. It has not come yet. So here's your hourly chart. And maybe we are consolidating. We're just doing it in a wide range. If we continue to gravitate back towards 3,800, back towards the hourly mid-band, then it'll be a consolidation, but it'll be the kind of consolidation where you can, there's plenty of elbow room to work and get your handles made and things like that. But you can see, daily mid-band resistance. I pulled up the daily chart yesterday in the chat room in the morning, and we spent most of yesterday. We had a long, we had a really nice short, and then we had to get long. It's because I tell you guys every day, you can't get dug in, you can't get ideological, you can't say to yourself, well, the tape is supposed to do ABC. No, it's not. I mean, you just have to follow price around, and the advanced decline line was sitting at negative 480 and change, on the lows yesterday, and as they start chipping away at that, you end up, it's at the zero line, a few hours later as it starts to grind up. I am a believer in the advanced decline line only when we're trending, and only in this sense. If you have extremes on the advanced decline line, 450 and above, negative 450 and above on the S&P, it's like trying to swim with a cinder block on your neck. And people that have followed me for years, yes, I'm going to give this analogy again, and you're going to sit here and you're going to listen to it and you're going to like it. So it's like trying to swim or tread water with a cinder block around your ankle. You may get back to this, up to the surface, but you're not going to stay there very long. The cinder block's going to win, and you're going to, get sunk back down. And it's a pretty rare situation where you can throw that off, and when it is, you got to pay attention to it. So most days when they get, AD was through the roof on Tuesday, closed up on the highs. It was down in the dumps Wednesday morning, but we've seen this in the past. The bears couldn't hold it. And they had every advantage in the world. And we end up closing near the highs again. And that, as much as anything, is why, if not today, then tomorrow after jobs, the bears need to reassert themselves. They need to reassert themselves because they have a little bit of egg on their face from yesterday. I mean, that was your classic V. They took it right back up. And they have to overcome things like that. And starting with daily mid-band resistance is a good start. What else do I have for you? You got the 5-minute chart here. You got volume weighted average price, 37.95 and change. Proprietary moving average dipping down in there. It's sitting at around 79. You see the hourly mid-band there hooked up with the monthly pivot, 37.91 half. Spent a lot of time yesterday. Yesterday's over here. I'm over here. Yesterday dealing with the monthly pivot. And they come up and do 38.20. They come down and they bounce it right off the monthly pivot. And they take it, and they take it up a little bit after the close. This really was a moment for the bulls to assert themselves, because if you find 38.20, basically the new daily mid-band, come back, hold monthly pivot, do a higher high. That's classic bull behavior. But what happened? They grind it back up, can't get through, lower high, give it up. That's why at a minimum, this is a two-sided market, and most likely we're still in a sell rallies, bearish type market. And for the bears to assert themselves, if they can hold that daily midband there, the green line, through the end of the week and into next week, then look, pops are going to happen. It's not Wile E. Coyote off a cliff every day, okay? It's just not. I know that people get bared up and they would love it to be, but that's not the way markets work, okay? And I know there's inflation right now and there's other things going on, but like the moon's not crashing into the earth, so settle down. It's a downtrending market, and so you're gonna get rally pops. You can't fight those pops. You can be long, you can stand aside. You can't be short them because you'll get nuked. They'll take you from Sunday night, during Sunday Night Football, we bottomed out at wherever we were, 30, whatever, 71 or whatever it was, and they took it straight up to 38.20. You can take advantage of that move on the long side. You can sit on the sidelines, watch the move, and complain. But what you can't do is be short and add and add and add and add and add like a moron, and then, not make any money. On the long side, if your target was, and look at the thing a couple days ago, I believe I entitled the webcast, Why Targets Are Stupid. If your target was the daily midband, it was 38.40, 38.30, now it's 38.20. Did we ever hit the target? No. Should you have taken profits? Yes. Should you be out of those trades? Yes. Does it matter that the target wasn't hit? No. And that's why targets are stupid, and in the end, they'll cost you money. They'll get you out of stuff you need to be in. They'll keep you in stuff you need to be out of. So I was glad to see that kind of play out in real time. All right, that's all I got. Everybody have a fantastic day. Be safe, be healthy, take care, trade them well. I will talk to you tomorrow.